Good morning. My name is Ashley Verriger, and I'm a Senior Lead Advisor here at Foster Group. Today, I'm joined by my colleagues, Walt Mosier and Marcus Eiwig, both Senior Lead Advisors on our team. And we would like to welcome you to our webinar entitled Risky Business, Avoiding Common Executive Compensation Pitfalls. Today, we're going to discuss the top mistakes that we see executives make with their equity compensation and how to avoid those, some strategies that you can use so that you can keep more of your hard-earned money in your pocket. Before we get into the content, a couple of housekeeping items to walk through. Number one, today's webinar will be recorded. It will also last 30 minutes. Next week, we'll send you a link to the recording in our investment e-news so that you can rewatch it at your leisure. On the bottom of your screen, you'll see a Q&A button. Please feel free to submit your questions at any point during our presentation, and we will follow up with you after the webinar has concluded. We'll be reaching out by email. With that said, let's jump right in. Today, we're going to cover a few common mistakes that executives make with their executive compensation and bring you a few ideas and strategies to mitigate those obstacles. Before we get started, let's paint a picture, tell a story, use an analogy. For many of the executives that we work with, managing their equity compensation, which can be a little complicated, is a lot like playing a poker hand when you've been dealt great cards. It's really hard to beat what you can see on the screen, kings full of aces. And it can be very tempting when you pick up these cards to go all in, to say, I'm going to put it all on the line because I'm overwhelmingly likely to be successful with this hand. It doesn't feel risky, but what we've seen in the work that we've done with executives and at the poker table is that if we want to keep playing hand after hand, round after round, into the wee hours of the morning, from time to time, it makes sense to take some of those chips off of the table so that if probability isn't on our side and someone does have a better hand, we'll still have chips to continue playing. So while I understand that you have a story to share that kind of relates to this idea of playing a poker hand, tell me more.
I do, Ashley. Well before Newton, Iowa was known for its iconic racetrack, it was home to the Maytag Corporation. And about 20 years ago, I had a client who was a sales executive at Maytag, and he was what I would call all in on Maytag stock. He owned stock through his employer stock purchase plan. He had an abundance of stock in his 401k plan, and he had in-the-money stock options. Well, around the same time, the CEO of Maytag had been telling his executive team that he felt like Maytag stock was going to go to $90 a share. He was quite bullish on his company stock, but it had only been trading in the mid-60s to mid-70s at that time. Unfortunately, a few weeks later, Maytag stock plummeted all the way down into the mid-20s. And my Maytag heavy client was, of course, devastated and felt as if he had made the wrong decision. Unfortunately, I saw his personal net worth drop by between half and 2/3. To make matters worse, this was within a few years of his own intended retirement date. So not a great way to think about pre-retirement planning for him.
You bet. And what I drew from this story, Walt, that you told is that how he didn't necessarily feel it was that risky to keep staying all in. I mean, he owned Maytag in a variety of places everywhere, his 401k, his options, his RSUs. It's how he was compensated with his salary and his bonus. Do you think there's a reason it didn't feel all that risky to him? I mean, psychologically, there's a few that I can think of.
Well, I think as an executive, you tend to believe in your own company. And so you can load up and not really, and sort of be blind to the risks of holding that much stock. And I think some of it's just human behavior. You believe that as it's going up in price, it's gonna keep going up and you're gonna benefit from that appreciation.
I think you're spot on the money. That optimism and that confidence can be really hard for executives to counteract because those forces are so powerful. I think there's another one in the mix too, which is just inertia. You have to do something about these awards and these grants each and every year. And so it's easy to just let that snowball keep rolling down the hill. It keeps getting bigger and bigger. And it's very difficult to stop once it's gained, some serious momentum. With that, I think that illustrates a very common problem that we see with executives and their equity comp It's just managing some of that human behavior risk and alternatives, which would be, diversifying the portfolio and lowering some of that overall risk. Walt, tell us about some of those common mistakes and pitfalls that you're seeing your executive clients encounter when it comes to their restricted stock units.
Yeah, absolutely. So back in the Maytag story, stock option plans were much more popular back then. Fast forward to today, and those have largely been replaced by restricted stock units, known commonly as RSUs. Now, an RSU is simply a right to acquire common stock at some future date. And there's caveats that come with that. The biggest one actually is just remaining employed with the company that you're working for. There may be others as well that are often outlined in the RSU agreement. But let's talk about some of those pitfalls. I have three main pitfalls I'd like to cover today. The first one is really not understanding how RSUs are taxed. Often when someone receives compensation, the tax event occurs right at that point. But with RSUs, they're granted in blocks. And that grant date does not trigger taxation. So that is one possible misconception. The taxation actually occurs when they're vested, which could be, say, 3 years later. And so there's a vest date that comes with the RSU agreement. And you take the number of RSUs times the stock price on a given day, multiply them together. That's your gross compensation for that RSU transaction. Now, these are taxed on your W-2, which means you're going to pay ordinary income tax. You're also going to pay FICA or Social Security tax, as well as Medicare tax. And so it's a gross compensation that's then added onto your salary and your potential bonus for that particular year. So that leads us to pitfall number 2, which is not withholding enough tax upon vesting. And this is a fairly common one because many executives are in a fairly high tax bracket, and the companies they work for are only providing for a certain amount of withholding, typically the statutory rate, which could be 22%. And so the way that works is the company will actually withhold a certain number of shares, roughly equal to the tax portion of that transaction. However, if you've got an executive who's in the 37%, which is the top tax bracket, there could be a 15% gap there. So how to make up for that could include things like doing additional withholding through your salary or bonus. It could include making estimated tax payments, or it could include just paying the tax at the end of the tax year when everything is calculated. Ultimately, this is all added on top of salary and bonus, and so it can end up having this stacking effect. The third major pitfall with RSUs is being overly concentrated in your employer's stock. It can seem tempting and even maybe advantageous to, after wave after wave of RSUs vesting, that you accrue a certain number of shares, maybe 5,000 shares of company stock, for example. The trouble with that is you're concentrated in that company stock, and it's not as diversified as taking the proceeds, buying a diversified portfolio, and sort of planning your way through that sort of mechanism. By having a concentrated position, yes, you do get the capital gains tax treatment if you hold those shares for a year and a day after the vest date. However, I would argue that the concentration is not worth the risk. And remember the Maytag story I told just a few minutes ago as an example. So it may be a better approach to offload those shares on the day that they vest or shortly after, because the tax basis is established on the day that those shares vest, and then there's no additional tax if you sell them soon after. Because history is rife with examples of executives who, during a downturn, they may lose their job. And of course, if the company stock is also going down at the same time, they lose a substantial part of their nest egg or their investment value. And that's not a good way to, plan for the future.
A double whammy, an income loss and a wealth loss. So what I heard from you is be mindful of tax, don't underpay, and make sure that you understand your risk profile with your concentration and diversify appropriately where needed.
Exactly.
Let's turn to you, Marcus, for some of the ways that we see executives struggle with and maybe use or misuse deferred compensation. Plenty to go on there.
Yeah, so I'll be talking about a couple common mistakes with deferred compensation. And what deferred compensation is generally a supplemental benefit to highly compensated employees and executives. It's a little different than like a 401k because it's not regulated by ERISA, which means you can typically defer much larger amounts of money into this plan. Like your 401k, you can make a deferral election, you can choose an investment option, but you've got the added complexity that you also have to select a distribution plan or a date that you're going to receive that compensation in the future. The other thing to know about deferred compensation is that in most cases, it's considered part of the company's general assets until it's paid back out to you. Meaning, if the company would fail to meet their obligations or go insolvent, you could lose that pool of money. There's a few things that typically lead to mistakes with deferred compensation. First and foremost, if you haven't established your goals and establish a financial plan, it can be really hard to make decisions around deferred compensation, especially when you get to that bullet 3 with a distribution plan. It can be really hard to figure out when to take that money back out of the plan if you don't know where you're headed and when you want to get there. The last thing is lack of time. We know executives are very busy people. These plans are a little bit more on the complicated side to understand. You really need to review your plan document and understand the ins and outs of them. And that lack of time, coupled with those other things, can sometimes lead executives to make arbitrary decisions, especially around when to take those distributions. So let's look at a couple examples. The first common mistake we see is deferring income to a future date in which you'd expect to have higher taxes. So our first fictitious executive, Jen, is 45 years old. She's mid-career, and she's a vice president, and she's recently become eligible for deferred compensation, the deferred compensation plan. Jen has decided to save 25% of her bonus into the plan, which is great. We're going to save income we don't need right now for a future time. But Jen is selecting to have that deferred compensation paid to her technically at separation of service. Now, that's one thing to be aware of. Many people think about retirement when they're electing to take the money at separation of service, but those can be two different things. And in Jen's case, she's often pursued for different jobs at other companies and thinks she may take one of those in the not too distant future. So what can happen is that Jen's deferring this bonus for the next 3 or 4 years, and that's what you see on the screen. The blue bar represents the taxes she's paying. The gray on top represents taxes she's avoiding right now by deferring that income to a later date. But if she takes a new job in the next 4 or 5 years, represented by that bar in 2028, Jen's probably getting a higher paycheck at the new company. She's probably received a signing bonus, and she very well may have had some RSUs vest when she left and had some accrued vacation paid out. And then she's layered on all that deferred compensation payout in that year. And likely she's paying a much higher tax rate on that money than had she just taken it along the way. So what we try to encourage younger mid-career folks to do, if they're not sure they're at their last company, is modestly use deferred compensation as a tool, or maybe not use it at all until they know they're towards the end of their career or at their last stop from a company standpoint. Now, the second mistake I'm going to cover is probably the most common mistake we see. Here we have Jerry, who's 57, and he's 5 years from retirement. So good news, Jerry's probably at his last stop as far as companies go. He's deferring 30% of his base compensation into the plan. Also, victory, we're saving money that we don't need today for a future time. However, Jerry keeps selecting when he's making that deferral election each year that he wants that money to come to him as a lump sum at separation of service. So what happens with that is that Jerry is going to get all those years of deferrals in one lump sum because he keeps electing that year over year. And so that can look like this, which is, again, Jerry's saving some measurable tax dollars the next handful of years, but then that year of retirement or year after, he's receiving the equivalent of probably multiple years of his income. Because remember, not only has he deferred 30% of his base for 5 years in this situation, he's also got investment growth on it into one single payment, again, likely costing himself substantially more tax dollars than had he just taken the money along the way. Instead, what we want to do is work with Jerry to develop a financial plan to map out his cash flow needs in the future and project his tax rate. So in Jerry's case, and it's important to note that this is a very specific example that may or may not apply, Jerry's retiring at age 62. His full retirement age for Social Security is likely 67. And so we might work with Jerry to figure out a way to build his deferred comp plan up and have it pay out over 5 years, bridging the gap from retirement at 62 to when he turns his Social Security benefit on at 67. These are the things we like to do with clients to help them get the most out of their deferred comp plan and capture that tax savings benefit that it's really there to do.
So what I'm hearing is build a bridge, don't double dip in the year that you
Absolutely.
work.
Absolutely. Yes.
Great advice, Marcus. From an income tax savings perspective, we heard both Walt and Marcus talk about items to be aware of and pitfalls to avoid. Now we bring you an opportunity that you can take advantage of as an executive that's particularly valuable to you in a high income year. Maybe you're having RSUs vest, maybe you're having deferred compensation pay out to you, or maybe both things are happening in the same year. Recall that when both of those kinds of events are happening, all of the income that you're going to be receiving is going to be ordinary in character, meaning it's going to show up on line 1 of your 1040 tax return, just like your wages and your bonus would. And so in our work as advisors and with our expertise, we know that the most effective income tax offset to go against ordinary income and mitigate some of that high tax potential is itemized deductions, which shows up on Schedule A of the tax return. We've got that on screen. There's a number of different categories of deductions that we can use to help offset that higher income in that big year. And clearly the most effective strategy that's the happiest of any of these options is making charitable gifts to the organizations that you love to support. So high earners, executives, whether they've got RSUs vesting or deferred comp being received, they can use charitable giving to bring down some of that very high income in those big income years. And that primarily takes on 2 forms of gift to those charitable organizations of choice. We can either keep it real simple and do a cash gift, that's easy, or we can get more creative if we're low on cash or if we have some appreciated property that we'd like to utilize to benefit those organizations we love to support. That could look like marketable securities like stocks or bonds that have appreciated in value in your portfolio. Fabulous asset to give. It could look like real estate, whether that's residential, commercial, business, or agricultural property. That can be donated as well. Business interests like company stock or other entity ownership is a candidate, and so are even goods like collectibles, art collections, antiques. Even those things that you have a great collection of can benefit the charities that you love to support. And so then our next question is, how do we make that happen if we want to take advantage of this charitable giving deduction to help offset and bring down some of that high income? We can keep it simple and do a direct gift to the charity. That works best with cash, but we can also contribute appreciated property like real estate or collectibles or business interests or marketable securities to that charity of choice. But recall that they're not really in the business of liquidating those special kinds of assets. We want to get them cash that they can use in hand to fund their operating budgets or to advance their capital projects. It may be a little bit harder for them to unwind some of those property gifts and turn them into money that they can use to support their mission. And so as a result, one of the vehicles that we often recommend executive families use is a donor advised fund. It's a special kind of charitable account that's incredibly useful for facilitating gifts to charities and accelerating deductions in high income years when they will be the most valuable. So typically this kind of account will be funded with either a mix of cash and marketable securities or some of those properties that I mentioned earlier. The charity, good news, is going to receive a cash grant because any property that we contribute into this account is immediately going to be sold and liquidated so that the charity is receiving the gift in the most useful format for them to receive it in. And for executive families, a lot of times we'll suggest a bunching strategy, meaning if we have a client family that uses or gives a certain amount of charitable gifts each year, let's bunch a few of those years together into one high income year to accelerate those deductions and be especially valuable to them. How does that work in practice? We'll show you with this diagram on screen. We've got Dan and Debbie Donor. They're both executives. They're a married couple. Dan has some RSUs vesting this year. Debbie is recently retired and is going to start receiving some deferred comp. And typically they're giving $20,000 to their favorite charities every year. If we used a donor advised fund strategy for them, we might consider that we might recommend that they consider giving $100,000 or representing 5 years of their annual giving and contributing that amount of cash or property or stock into that special donor advised fund. When they do that, they're going to receive a deduction on their taxes in equal value to the value of the gift. So a $100,000 gift goes in, they're receiving a $100,000 deduction in the year that they can most use it when they have a lot of income headed their way. The beauty of this account is that then Dan and Debbie can still make those gifts to their charities on their schedule. $20,000 this year, $20,000 next year, $20,000 the year after. There's no requirement that if 100 goes in this year, 100 also needs to come out this year. It allows them to accelerate the deduction, but continue their giving plan from a time perspective. Incredibly powerful technique for our executive families to consider as they look to mitigate some of those income events that are part of being a high earner and an executive in a company. That's all the time that we have for today. Before we close with you, a couple of key reminders. Number one, we've recorded this webinar so that you can come back and watch it. We also welcome you to send it to a friend. You'll be receiving a link to the recording via email in our next e-newsletter. For those of you who have joined us today that we have the pleasure and privilege of serving, thank you. It is so meaningful to sit down with you, to accompany you on the financial journey of life so that we can help you achieve that life of meaning and generosity. If we don't already serve you, we would welcome a conversation with you. We would love to get to know you, to hear what's on your mind, to help you plan, and to make sure that your financial life is truly cared for. Please use the contact information on the screen to start a conversation with us. Last but not least, as we learn more about hosting webinars, we welcome your honest feedback. In the next couple of days, you'll get an email with a survey, and we would encourage you to use that opportunity to share with us all of your feedback related to our webinar and our presentation today. Last but not least, use that Q&A button to submit any final questions. Use the QR code on screen, and you'll be able to download our free book, Executive's Financial Guide. Thank you again. Have a great day.